The global silver market is showing signs of a deep structural break, not just volatility or speculation. Across the world, silver is no longer priced as a single asset, but as multiple realities depending on geography and form. In Western financial centers, the paper spot price still floats around $73 an ounce. Yet in much of Asia and the Middle East, physical silver trades at levels that shatter that illusion. In Tokyo, buyers are paying close to $130 per ounce. Dubai reflects prices above $115, while China consistently trades north of $110. This is not a temporary spread, it is a visible fracture between paper promises and real metal. Japan offers one of the clearest examples of why this divergence exists. The collapse of the yen, driven by unsustainable debt levels, and a central bank trapped in perpetual bond intervention, has pushed savers toward tangible assets. With Japan's debt exceeding 260% of GDP and confidence in monetary stability eroding, silver has become a lifeboat. Local demand is not speculative, it is defensive. As currency purchasing power melts away, physical silver prices rise to reflect real protection value rather than abstract futures pricing set thousands of miles away. In the United States, the same disconnect exists beneath the surface. Although the official spot price suggests stability, anyone attempting to acquire physical silver encounters a different reality. Major dealers routinely charge $80 or more per ounce for bars, signaling a hidden floor price tied to replacement costs and scarcity. This reveals a three-layered market structure. A paper price divorced from supply constraints, a U.S. physical market acknowledging tightening availability, and an Asian market pricing silver as a strategic necessity under stress. The arbitrage mechanism that should collapse these differences is no longer functioning. Ordinarily, traders would buy cheap silver in New York and ship it to higher-priced markets, quickly equalizing prices. That mechanism is broken down. China's new export licensing rules now restrict silver exports to a narrow group of refiners, effectively trapping the majority of global refined supply within its borders. At the same time, logistics have become a choke point. Secure air freight for bullion is saturated, insurance costs have surged due to geopolitical instability, and vaulting infrastructure is stretched thin. These frictions prevent physical silver from moving freely, freezing price disparities in place. Dubai's market further exposes the strain. As a traditional hub linking Europe, Africa, and Asia, it should benefit from arbitrage flows. Instead, it suffers from scarcity. European refiners increasingly ship directly to Asia, chasing higher premiums and bypassing intermediary markets. This creates a vacuum in Dubai, driving prices even higher and reinforcing the sense that physical silver is becoming regionally stranded rather than globally fungible. Industrial demand adds another layer of pressure. In South Korea, where silver is essential for electronics, batteries, and semiconductor manufacturing, prices nearing $97 per ounce reflect desperation rather than speculation. Factories are paying whatever it takes to keep production lines running. These prices represent true replacement costs, not financial engineering, and they validate the higher valuations seen across Asia. Behind the scenes, Western bullion banks are trapped in a dangerous position. Years of selling unbacked futures contracts have created massive naked short exposures. These positions remain survivable only as long as silver prices stay artificially low. A genuine repricing towards the physical market S valuation would generate losses large enough to erase bank capital and threaten systemic stability. As a result, the paper market is flooded with synthetic supply, not to manipulate profits, but to delay insolvency. Physical silver quietly drains eastward while paper claims multiply in the west. This imbalance mirrors a modern version of Gresham's law. Paper silver, abundant and cheap, circulates freely, while physical silver disappears into vaults and factories where it is hoarded and consumed. Investors increasingly test the system by demanding delivery on paper contracts, accelerating the drawdown of registered inventories. COMEX stockpiles continue to shrink, approaching levels that raise serious questions about fulfillment capacity. As inventories thin, the credibility of the paper price erodes. Once physical supply in Western vaults is exhausted, the quoted spot price becomes meaningless. The eventual correction is unlikely to be smooth. When confidence breaks, prices may surge violently to align with physical markets abroad. Faced with this scenario, exchanges may intervene with emergency rules, trading halts, or forced cash settlements at capped prices. Such actions would protect institutions, but impose real losses on holders of paper claims, confirming that in a fractured market, ownership of physical metal is not just an investment choice, it is the defining line between promise and reality. Logistical strain is a major force widening the gap between paper and physical silver prices. Even when traders identify clear arbitrage opportunities, the ability to move metal has become a serious bottleneck. Armored trucking fleets and secure air cargo capacity are booked weeks in advance, making rapid deployment of physical silver nearly impossible. At the same time, airspace closures near conflict zones and rising global security risks have pushed insurance premiums sharply higher. These costs reduce shipment frequency and volume, reinforcing the price divergence and preventing the market from naturally rebalancing. Warehouse constraints add another layer of friction. Banks and storage providers increasingly require extended lead times, sometimes several weeks, to convert unallocated positions into allocated metal. This reflects genuine difficulty in sourcing available bars, but it also functions as a delay mechanism. By slowing the transition from paper claims to physical delivery, these procedural hurdles choke off arbitrage flows and allow regional price disparities to persist. In practice, this acts as a defensive strategy by financial institutions, attempting to preserve control over a suppressed pricing structure. As this fractured system moves toward its breaking point, the eventual outcome appears unavoidable. Once logistical constraints ease or Western stockpiles are depleted, the price gap will snap violently. Western prices will be forced to realign with Eastern physical markets, not gradually, but in a sharp repricing event. Within this environment, Western mining equities present a unique asymmetry. These stocks are still valued using depressed paper silver prices, even as miners increasingly sell output into higher-priced Asian markets. As a result, cash flows and margins are improving beneath the surface, creating leveraged upside that is not yet reflected in equity valuations. In this context, holding physical or fully allocated silver becomes critical. Unallocated accounts and futures-based exposure carry significant risk during a disorderly repricing. In a forced settlement scenario, holders of paper claims may be cashed out at suppressed prices, losing real purchasing power at the exact moment silver revalues higher. Allocated holdings, tied to specific bars and clear ownership, provide insulation against these outcomes and ensure participation in the true price discovery process. The broader implication of this silver fracture extends beyond one metal. It signals a weakening of Western dominance in commodity pricing and financial control. Bullion banks' inability to supply physical metal in the face of sustained Eastern demand reveals a structural power shift. Paper-based price suppression is no longer a stable mechanism, but a temporary defense against systemic exposure. Physical markets, industrial demand, and sovereign strategy are steadily overwhelming financial engineering. When silver finally breaks above the psychologically critical $100 level in Western markets, the shift in perception will be dramatic. Silver will no longer be viewed merely as an industrial input or speculative asset, but as a Tier 1 monetary metal alongside gold and, increasingly, Bitcoin. This transition will likely ignite intense investor fear of missing out, drawing in institutions, sovereign entities, and long-term capital. Industrial users will scramble to secure supply, reinforcing a feedback loop that could propel prices toward $200 and beyond in a sustained supercycle. This unfolding silver crisis mirrors deeper vulnerabilities in the global monetary system. Currency debasement, supply chain fragility, and geopolitical fragmentation are no longer abstract risks. Japan's HOS experience serves as a warning signal for the United States and other Western economies burdened by rising debt and eroding fiscal discipline. The silver squeeze in Tokyo is not an anomaly but a preview. The sustained $50-plus price gap between East and West, the mounting insolvency risk among bullion banks, the logistical choke points blocking arbitrage, and China's strategic export controls together mark the end of a single global silver price. What replaces it is a fragmented system where physical ownership determines value. This transition represents a major shift in wealth preservation and transfer. Those who understand the dynamics and position themselves in physical, allocated silver and undervalued mining equities stand on the right side of the coming reset. The so-called Tokyo shock is not a regional event, but a global signal that the era of paper price illusion is nearing its end.